Good afternoon, everybody. It's a real pleasure to be here in this wonderful place, in this Bucharest amphitheater of the University of Economic Studies. And I would like to thank my friend Daniela, who has kindly invited me to share some, I would say, thoughts about the book I have just issued a couple of weeks ago, and it is available easily. So one of the central idea, I would say, of the book could be summarized as follows. The euro has not fulfilled all its promises because some member states have refused to adopt the economic discipline necessary for the European Monetary Union to function properly. And today, I think the euro is once again in danger. Monetary union is indeed based on trust and shared discipline and on economic commitments, but these have disappeared, resulted in collective weakness. If the most indebted countries do not regain control of their public finances quickly, and if no binding mechanism is put in place to ensure compliance with the rules, the Eurozone risks facing an existential crisis. In particular, France could trigger a shock that would jeopardize the Euro's viability as a whole. I will divide my remarks into 4 sections: the current worrying situation in the Eurozone, second, why the euro has not fulfilled all the promises, third, why the euro is in danger, and fourth, the conditions for recovery. The situation is worrying. Since its creation, Economic and Monetary Union has weakened rather than strengthened. The euro was supported when it was created in 1999 to promote economic convergence within the zone, strengthen financial and banking integration, and support political unity. However, the Eurozone now is composed of heterogeneous economies. The monetary union has widened the gap among member states, and the monetary union has become a collection of disunited states. It survives only by allowing its weakest members to take on ever-increasing debt. Of course, the advantages of the euro remain: no exchange risk, greater price transparency, and integration into pan-European value chains. The problem is not the euro itself. It's the lack of fiscal discipline in several countries, such as France and Belgium. Instead of improving competitiveness, national and European leaders let public finances deteriorated by supporting consumption and redistribution rather than investment and private initiative. Macroeconomic divergences has widened, and the debt of several countries has increased sharply. The argument presented in this book leads to a set of clear conclusions. First, the most indebted countries, France, Belgium, Italy, have experienced the largest productivity declines over the last 20 past years. Second, countries with the highest public spending are also the least competitive. Indeed, high spending increases taxes, raises production costs, and discourages investment. Third, unemployment is highest in the most indebted countries. And fourth, low returns on savings have caused a severe decline in productive investment, explaining much of Europeans' underperformance since the euro was created. To conclude this first part, I would say that these sharp economic divergences have fueled mistrust between member states and encourage short-term national interest. They limit Europe's ability to take bold political decisions and have slowed banking and financial integration. How did we get there here? I would say that first, the absence of corrective mechanisms within the monetary union and the protective role of the euro have amplified imbalances. Unlike the former European monetary system, the single currency removed the warning signals. In the past, as you have probably, I would say, learned, fiscal discipline forced countries to devalue their national currencies, which immediately reduced purchasing power of citizens. This discipline has disappeared in the Eurozone. In fact, the rules of the Stability and Growth Pact was violated repeatedly without consequences. And European institutions have implicitly tolerated the inexorable rise in debt levels. In reality, and I think you should keep that in mind, the protection offered by the euro can encourage bad economic policies and delay necessary corrections. France is a clear example. Despite more than 18 months of political and fiscal turmoil, long-term interest rates have barely risen, and stock markets have reacted only mildly. Unless the European monetary system, the French franc would have been devaluated and France forced to adjust. So the euro therefore masks and ultimately reinforces economic disparities which undermine its viability. The responsibility of the ECB's ultra-accommodative monetary policy between 2008 and 2022 is also one of the explanations. Unconventional monetary policy helped, of course, Europe to absorb shocks: the global financial crisis, the sovereign debt crisis, the COVID crisis. But for 20 years, various crises have been absorbed by money creation. However, it is important to note that financial crises are always the result of excessive debt. And this very accommodative monetary policy of the central banks of the ECB in particular have encouraged excessive borrowing, pushing debt to record peacetime levels. And this massive injection of liquidity combined with persistently low or even negative interest rates have led to excessive debt, misallocation of capital, weakened business dynamism, and slower productivity growth, while fueling financial stability. Massive money creation have also encouraged relaxation of fiscal discipline among member states. It has delayed structural reforms that are essential for potential growth and has been accompanied by a significant increase in wealth inequality. Third reason which explains the current worrying situation is the following. The disciplined countries believe that they are benefiting from the situation given the undervaluation of the euro in these countries. Northern countries, notably Germany and the Netherlands, which have competitive industries, have benefited during the 25 past years from a depreciated euro in real terms. This has strengthened their export competitiveness. Indeed, the external value of the euro represents an average for the entire economic zone and appears undervalued in relation to their economic performance, giving these countries an additional competitive advantage. Without the euro, their national currencies would have appreciated, eroding the price competitiveness of their exports. At the same time, the euro has prevented the depreciation of the currencies of the southern countries, including France, that would have occurred in its absence due to their inflationary pressures. Without the euro, their currency would have undergone repeated devaluations, which would have been detrimental to their population, particularly in terms of purchase power. These devaluations would have reflected market forces and promoted competitiveness, provided that domestic demand was properly managed to contain inflationary pressure and reduce the propensity to import. So, to conclude the second part, I would say that stability, therefore, comes at a cost, reduce competitiveness for southern countries, and increase competitiveness for northern countries. So why now the euro is again at a critical turning point? First, the excessive debt of certain founding countries and the lack of competitiveness of their businesses and the resulting low growth threaten the survival of a common currency. Ladies and gentlemen, and dear students, a monetary union cannot survive without a minimum of economic discipline on the part of its member states. It can only function properly if countries are constantly following, it cannot function properly if countries are constantly following opposite economic paths. Public finances are the central problem. Debt levels in several founding countries like France, Italy, Belgium, Spain are now dangerous. And France is seen as the weak link for four main reasons. First, more than 50% of its debt is held by non-residents. Second, France has not achieved a primary fiscal surplus since 2022. Third, France has structural trade deficit. Fourth, private debt is extremely high in France. Be aware that interest payments will rise from 60 billion in 2024 to nearly 100 billion euros in 2027, or 3% of GDP, in economics struggling to grow by 1%. This is not at all sustainable. So a crisis scenario is conceivable, especially since the leaders of the European institutions are not making recommendations that are commensurate with the challenges at stake. The leaders of European and international institutions tend to mask these differences by referring only to the economic indicators for the Eurozone as a whole, which are averages of very heterogeneous national performances. Have you heard any European leaders from the Commission, the European Stability Mechanism, the ECB, or even the IMF express concerns about France's budgetary and political crisis over the past 18 months? On the contrary, on the 26th November 2024, for example, the European Commission approved France's draft budget for 2025 and its budget plans for the following years. Despite the resignation of the government, of the Barnier government, and the French Parliament's rejections of the draft budget, on 11 December 2024, the European Council endorsed the Commission proposal, the height of absurdity. It is the member states, aided by the European institutions, that are putting the euro at risk. You could say that perhaps the euro is less exposed than the dollar to mistrust, but I think it's the opposite. It's the euro which is more exposed to market mistrust than the dollar. Why? Because unlike the dollar, the euro is not backed by a deep financial market or a unified political and military power. Its vulnerability is exacerbated by fiscal and economic fragmentation, and a lack of economic discipline. The United States is still protected by its technological leadership, its status as the world's leading military power, and its energy independence, while the euro is weakened by the economic weaknesses of its members and fiscal and political fragmentation. So to conclude my speech, I would like to end on a positive note by proposing conditions for the revival of the economic and monetary union. The decline is not irreversible. The conditions for Europe's resurgence are known. I would say that internal consolidation is a prerequisite for international integration. In other words, fiscal discipline is essential in all countries. All member states must work together to improve the economic level of Europe as a whole. This means that they must begin by respecting first their fiscal and economic commitments they have freely entered into in a spirit of solidarity. This is also the way to restore confidence between heads of states and government in Europe, and in particular to re-establish a genuine alliance between France and Germany, the driving force behind European integration. Can we indefinitely consider as acceptable and credible a union whose funding rule, a minimum level of fiscal discipline must be respected, is violated constantly by a number of member states? We must stop believing that the permanent violation of budgetary commitments freely agreed and ratified by national parliaments is a solution. Instead of calling for illusory European funding and pursuing easy monetary and fiscal policy, we must start rolling up our sleeves. We must clean up our public financing and get back on the path to economic convergence in Europe. Why is certain and is that we must ensure also that returns on savings in the Eurozone are at least equal to those in the United States, and that a climate of confidence is created to encourage individual initiative in Europe. In this regard, the current rate differential between Europe and the United States is glaring and must be corrected. What not to do is to think that structural problems can solve, I would say, our issues. Inflation, easy money will not solve everything, but productive investment, which is the basic for future growth, will. That is what needs to be encouraged and not discouraged, it with heavy taxation and excessive regulation. We must perhaps also following the case of Portugal, because Portugal has clearly demonstrated over the past years that a healthy economy goes hand in hand with sound public finances. Such an economic approach is essential to revitalize a Europe in decline and to capitalize on its strength. The problems and solutions are primarily national. Only strong states can build a strong union. Thank you for your attention.
Also for me, thank you very much for inviting me. Real pleasure to be here in Bucharest almost 20 years after the first time and also the last time that I actually was here. I'm from Belgium, but I once came to Romania for a Romanian language course that was in Baia Mare. But I also used a few days to get to know Bucharest a bit better, completely different from here today. Today I'm here to share with you some insights from a book that I published earlier this year. Also a completely different book, more on a micro level than what Didier just shared. A new ethos in banking, embracing ethics and values for a meaningful transformation. And it's a story not so much from me as much from the many C-suites in the bank industry that I spoke to and that I gave a stage at my own conferences a couple of years ago. We are currently living in technological acceleration, geopolitical uncertainty, and rising and changing expectations of what finance should deliver to people and society. We see that changing almost every couple of months. And against that backdrop, I'd like to return to a conviction that guides my work, and that was also the reason why I wrote this book. And it is that you cannot have a healthy economy without a healthy banking system. And the way I approached this was by looking at the banks themselves rather than the industry at large. If money makes the world go round, then banks are the veins that let it flow, especially in Europe, where bank intermediation sits at the backbone of financial architecture. When those veins clog, you have a problem, as we saw in the financial crisis many years ago. Healthy today means much more than capital strength or good governance. It also requires that the banking system kind of lives in symbiosis with its environment, with people, with companies, with regulators, supervisors, innovators, and society at large. And at the center of that symbiosis lies one currency above all, and that's one that you've heard many times already, and that's trust. So when we talk about monetary stability, we should not limit ourselves to macroeconomic indicators. We should not limit ourselves to regulation or innovation. It all begins with ethos. And ethos, for me, does not stand for a mindset. It stands for the translation of that mindset in the day-to-day behavior. It's translation of values, principles, intentions and convictions of organizations and people in their day-to-day actions. Ethos answers questions that numbers alone cannot. Why do we make certain choices? How do we treat customers when no one's watching? What do we prioritize when short-term pressure conflicts with long-term responsibility? I think a question that resonates increasingly more lately. Ethos defines culture, and culture shapes behavior, and it's behavior that builds trust. And without trust, monetary stability becomes fragile, regardless of technology or policy. So it's something that we should keep into account. Europe's financial sector is one of the most regulated in the world. And don't get me wrong, I am a fan of regulation. Regulation is an enabler of trust. It's rebuilding confidence after crisis. It's strengthening governance and protecting customers. But regulation has limits. And that is a message that I heard multiple times in the conversations with CEOs in the bank industry. When it becomes overly prescriptive or fragmented, it risks to become a disabler. It slows innovation, complicates customer experience, and creating competitive imbalances with non-bank players. But it also, and that's a very interesting insight I found, and that was one of the conclusions after the global financial crisis, is that overregulation risks to reduce diversity in the industry in terms of bank business models. And those different bank business models that also challenge each other to do better. It improves competition, and competition improves customer support, customer service. So regulation, I believe, should support the ethos, the behavior of people, not so much replace it. And a sector driven by values will innovate responsibly. On the other hand, a sector solely driven by rules will innovate reluctantly. So the challenge for the next generation, for the people here in the room, is to design regulatory frameworks that protect without paralyzing and encourage innovation while maintaining resilience, and that aim for better customer outcomes rather than procedural checklists. Regulation must set the rules for banks to do better than the bare minimum. Now, the book is called A New Ethos in Banking, and it was written before the elections of Trump, so you could argue to what extent it's still valid. I think it's still very valid. And there are a couple of themes that I highlighted in my book to explain why today, maybe for banks, it is the right moment to set their own identity again in their transformation instead of just copying what others are doing. And one key theme is technology. I don't know how aware you are of the trends in the bank industry, but there are a lot of hot topics like the idea of instant payments, embedded finance, digital identity, the fight against fraud, and AI. AI has a massive potential, according to me, and we look at it mostly from a chatbot point of view, but I think in a far future, the potential is much higher. Today, banks are still looking at improving efficiency with artificial intelligence, but I think in the far future, that will be completely pivoting business models, etc. And it has the potential for banks to start building their own identity in a digital world instead of just copying what others are doing. It encourages leaders to build organizations that are more transparent, more collaborative, more human-centered as well, but first and foremost to build a unique identity and not just doing what all the others are doing. And that is why I describe transformation not as a threat, but as a chance to renew the ethos of banks. And it's also why I talk about a meaningful transformation and not just transformation. It's an opportunity for every individual organization to reconnect modern banking with its fundamental mission, enabling progress for people and businesses. The other key theme, a bit less popular today than when I wrote the book back in 2023-24, sustainability and ESG. Climate change is often framed as one of the greatest risks facing the financial system. And it is. There's the physical risk, there's transition risk, litigation risk. They're all well known, well studied, and rightly taken seriously and heavily discussed like these days in Brazil. Supporting the transition to a sustainable economy will require massive long-term investments. And I agree, it's not just from banks, and maybe in Europe, less from banks than from other financial players. But it will reshape sectors, generate new industries, drive innovation across mobility, housing, chemistry, agriculture, and so much more. It was the head of strategy Europe of HSBC that told me that in terms of trust, the green transition is probably the biggest opportunity for the financial industry since the Industrial Revolution. Because of the massive investments required for banks, it is an opportunity to show to society that they are a partner in that transition and not just a financial player trying to make money. And that comes with responsibilities for banks today, but also for generations to come, like hopefully all of you. We will need banks to finance the transformation of our economics, support innovation in energy, mobility, housing, agriculture, chemistry, and so much more. Empower customers also to make sustainable choices, because those choices are hard. And most people outside this room don't understand what's going on for their lives today and for their kids tomorrow. And we need to position Europe's finance as a global leader in global stewardship as well, because as Europe, we are taking a position in sustainability, in ESG. I think it's a very good one. It's a very responsible one. And it's definitely a process that's living. Today, defense has become much more important than a couple of years ago. For the right reasons, has been discussed heavily. And I think those different elements, those different flavors also allow banks to make their own decision on how they wish to position themselves. And that way, finding the right people that match their brands. Again, it's about building that identity through intrinsic values, motivation, and strategy of a bank. Climate is more than a challenge. It's the ultimate test of the sector's capacity to serve society, the clearest opportunity to prove the values of a new banking ethos. And as a conclusion, I would like to share a very fun, a very relevant insight from the CEO, Michael Anseu, of BNP Paribas Fortis, Belgium's largest bank. And he shared that in terms of, like, if we want to rewrite the narrative of banking, that new ethos, for the well-being of society and the planet, then we should take an example of Mary Poppins. Mary Poppins, for the ones who don't know her, she was a very wise, fun lady in a pretty old movie. And she was there to take care of children. And what he said in comparison with banks is that she effaced herself for those children, as banks should also be doing for their customers. She was there to realize dreams. She made magic happen. And I think, and he thinks, that banks should be doing that as well. Not only looking at the KPIs, they should be a result of that realization of dreams. It's not about selling a mortgage, it's about facilitating people to have a house, to have that dream. And it's not just signature of a contract, that is a long-term commitment from the bank to the customer and the other way around. And perhaps banks should leave some of their seriousness behind and maybe add a bit more humanity and even humor to ensure that they get that connection with the customer again. Again, I think a skill that young people have much more than the older generation. And it is also an opportunity for all of you here to make a change going forward. So my call to action to the banks, and maybe to you in the future as well, is to write down your own story, see how it relates with the organization you work for, carve it into stone, so to say, and make it part of the day-to-day decisions that you make. Because what ethos truly is about translating beliefs into behavior, promises into action, and values into services. That was what my book is about. Thank you very much.